Then in step 2, you need to estimate future cash flows and then calculate a continuing value. All right, so first we need to estimate our future cash flows, and after we've done that, we can calculate a continuing value. Let's first look at estimating the future cash flows. Now guys, as per your lecture notes, I recommend that you calculate free cash flows by starting with profit before tax and then deducting tax paid. And the reason why we start with profit before tax is we are trying to calculate cash flows over here, meaning I'm not interested in the tax expense as per the statement of comprehensive income. I want the tax that the company actually paid during the period, so the tax cash flow. So I start with profit before tax because then I'm ignoring the tax expense as per the statement of comprehensive income, and I deduct tax paid because then I'm deducting the tax cash flow. So your free cash flows must be after tax, but it's after tax paid, not after your tax expense. Then we eliminate any non-cash items. So for example, if the company has depreciation, you'll eliminate the depreciation expense. And the logic behind doing that is we are trying to calculate cash flows. So obviously anything that is not a cash flow needs to be eliminated from the calculation. Then, if the company has any non-operating assets, so for example, if they have investments, those non-operating assets will be valued separately. And because those non-operating assets will be valued separately, any income that is sitting in profit before tax must be eliminated. So deduct any income relating to non-operating assets because those assets will be valued separately. Similarly, long-term debt will also be valued separately. So because it will be valued separately, included in profit before tax, you will have finance costs. You need to eliminate those finance costs, or in other words, you need to add back the interest on long-term debt. Eliminate it from profit before tax because long-term debt will be valued separately. Now, I'm going to stop my discussion there for now. I'll come back to the last two calculations once we've discussed this in more detail. Now, if you go back to the information provided in the question, we can calculate post-tax operating cash flows because we know that the company has a constant dividend payout ratio of 40%, and we know what the dividend was for 2018. So if we know the dividend and the dividend payout ratio, we can work backwards to calculate 2018 earnings. Then using that, we can calculate post-tax operating cash flows because post-tax operating cash flows are 80% of earnings. So guys, let's just jump to that calculation. If we want to calculate the earnings for Springfield, you were given the dividend that they paid in 2018, and you were also given the dividend payout ratio. So you can calculate their earnings per share using that information, and you can prove it. If that's the earnings per share and they have a dividend payout ratio of 40%, meaning they always pay out 40% of their earnings as a dividend, then the dividend will be 420 cents. So using that information, you can work backwards and calculate earnings per share because you have the dividend per share. Now, we obviously don't want this information per share. We want earnings in total so that we can get our total cash flows. But it's not a problem because you were told that Springfield has 1 million shares in issue. So you can easily calculate earnings in total, just multiply by the number of shares in issue. Then I'm just dividing by 100 because this is in cents. So I'm converting this from cents into rands. And then please remember, guys, as per the required, everything must be rounded to the nearest 1,000 rand. So just check your rounding there as well. All right, so that gives us earnings in 2018. And we know that post-tax operating cash flows are 80% of earnings. So just 80% of that earnings amount will give you your post-tax operating cash flows. Now, please remember, guys, when performing evaluation using the free cash flow method, we are only interested in future cash flows. So we've calculated all of this for 2018. If you go to the required, we need to calculate the value of Springfield at the 31st of December 2018. So if we are performing the valuation using the free cash flow method, we can only include future cash flows in our calculation. So we are not interested in their cash flows for 2018. We want the information for 2019, 2020, 2021, etc. We need the future cash flows. So go back to the information provided in the question. We were given forecasts for the future. You are told that post-tax operating cash flows, which we have, we've performed this calculation now for 2018. We know what the amount is for 2018. That amount is expected to increase by 6% per annum in real terms for the next 3 years. So in 2019, 2020, and 2021, this amount is going to grow by 6% per annum. But just be careful, that is 6% per annum in real terms, meaning it does not take inflation into account. So guys, if you are specifically told that something is increasing in real terms, you know that inflation has been ignored and you then still need to take inflation into account. So that's not a problem because just below we were told that the current rate of inflation is 5% per annum. So we've been given the real rate and we want to calculate a nominal rate. Remember, a nominal rate includes inflation. So we are trying to calculate a nominal rate that includes inflation because this 6% over here ignores or excludes inflation. So again, if you jump to the suggested solution, we use the Fisher formula in order to convert a real rate into a nominal rate or a nominal rate into a real rate. So what you do is you take the real rate and you add 1. So it's 1 plus the real rate. So 1 plus 6% because the real rate was 6%. Then you multiply that by 1 plus the inflation rate. And in this question, the inflation rate was 5%. So guys, if you multiply those together, that's what you get as your answer. And that is 1 plus n. So you need to deduct 1 in order to calculate n. So n is 0.113, or in other words, 11.3%. That is n. You have calculated the nominal rates. So the real rate excludes inflation. And the nominal rate includes inflation. So if we are trying to calculate post-tax operating cash flows for the future, we need to take this amount from 2018 and we need to increase that by the nominal rate. And remember, if you go back to the information provided in the question, this increase is expected for the next 3 years. All right, so you can calculate post-tax operating cash flows for 2019, 2020, and 2021. You obviously start with the 2018 post-tax operating cash flows and just increase by 11.3% each year. Just make sure you are using the nominal growth rate that includes inflation and not the real growth rate that excludes inflation. So if we go back to step 2, where we are trying to estimate our future free cash flows, for 2019, 2020, and 2021, we've calculated the post-tax operating cash flows. So just make sure you reference correctly to your calculation, and then you can just bring those amounts forward. Remember guys, when performing evaluation using the free cash flow method, you only include future cash flows in your calculation. So I do have a column here for 2018, but there's no cash flows in that column. The first cash flow that you input into your financial calculator will be 0. All right, so let's see where we are sitting in our calculation as per our lecture notes. We've calculated post-tax operating cash flows. So guys, first, these cash flows are post-tax, so tax has already been deducted, so that's perfect. We've taken profit before tax, we've deducted tax because this is post-tax. Then, these are operating cash flows. So obviously any income relating to non-operating assets will not be included in this amount because these, you're specifically told, these are operating cash flows. In addition to that, guys, any finance costs on long-term debt, that's not an operating cash flow, that's a financing cash flow. So if we've calculated post-tax operating cash flows, that has already been excluded because we are working with operating cash flows. In addition to that, if we are working with cash flows, then non-cash items have also already been eliminated. So guys, be careful. You can't always use the structure as per the lecture notes. You need to make sure that you understand what you've studied so that depending on the way the information is presented in the question, you can still answer the question. So that's extremely important, guys. We have calculated at this point over here, after processing all of those adjustments, you would have your post-tax operating cash flows. Then just one more important thing before I get onto the discussion of working capital and capital investments. One other thing, guys, that's very important. If you didn't see this link, if you weren't able to pick up that you can calculate earnings using the dividend per share and the dividend payout ratio, if you didn't pick that up, obviously you wouldn't have been able to calculate post-tax operating cash flows. If you have a situation like that in a test or exam, you can't just stop there. You can't say, oh, I can't perform the calculation and then stop there, because then you're going to lose all of these marks. And this is out of 23 marks, guys. You need to pass this part of the question, otherwise you're going to fail the paper. So it's very important, if you can't calculate this amount, if you didn't see that link and you couldn't calculate this amount, please just make an assumption. Make an assumption, any assumption, pick an amount. Because you'll see after this point, a lot of the marks are consequential marks, which are principal marks. If you perform the principal correctly, you will still be awarded the mark. So even if you make an assumption over here and you guess the incorrect number, obviously you'll guess the incorrect number. You're never going to guess the right number. So guess. Say, post-operating tax cash flows in 2018 are 10 million rand. Make a guess and carry on with the calculation. By doing that, you will still be able to pass this part of the required. So please don't let something like that stump you. Don't let an upfront calculation, all of your future calculations are now dependent on this calculation. So if you don't have this number, you can't go on. Make an assumption, guess a number, move on with the question so that you still give yourself a chance to pass. If you stop at that point, you're definitely not going to pass this part of the required. So in order to complete this calculation of free cash flows, we need to take into account the movement in working capital, and then after that we need to take into account any movement or any additions or disposals of capital investments. So for example, if the company disposed of any property, plant and equipment during the period, that must be taken into account, or if they acquired any new property, plant and equipment during the period, that must also be taken into account. And the reason why that must be taken into account is obviously that will affect the company's cash flows. However, capital investments or capital purchases are not sitting in profit before tax, because those would obviously be treated as assets and recognized as assets instead of expenses in profit before tax. So that's like property, plant and equipment. All right, guys, so if you go back to the information provided in the question, you are told that net working capital and capital investments should maintain a constant ratio to operating cash flows after tax until the end of 2021. Now, we just calculated operating cash flows after tax. So we have that amount, meaning we should be able to work backwards in order to calculate net working capital and capital investments, because you are specifically told that a constant ratio will be maintained. Now, make sense of this, guys. What is net working capital? Net working capital is current assets minus current liabilities. Now, at the top of this page, we were given current assets and current liabilities. So current assets minus current liabilities gives you net working capital. We have also been given property, plant, and equipment, or in other words, their capital investments, or their non-current assets. So if we add all of that together, we'll get the net working capital and capital investment amount for 2018, because this is obviously all of the information for 2018. Then, we know that a constant ratio must be maintained. So we calculate what the ratio is, and using that ratio, we can predict what the future cash flows will be for the next 3 years until the end of 2021, because we know that a constant ratio will be maintained until the end of 2021. So, let's first calculate net working capital and capital investments for 2018. So remember, net working capital is just your current assets minus your current liabilities. So that deals with the net working capital. And your capital investments is property, plant, and equipment. So that is net working capital and capital investments for 2018. And this amount is going to maintain a constant ratio to operating cash flows after tax. So we've already calculated operating cash flows after tax for 2018. Here's your operating cash flows after tax for 2018, 8.4 million rand. It's like a puzzle. So this will maintain a constant ratio to operating cash flows after tax. So take this amount and calculate what the constant ratio is. Divide by the operating cash flows after tax. Make sure you're being consistent. Both of these amounts are for 2018. You've got the net working capital and capital investments for 2018, and you are working with post-tax operating cash flows for 2018. Calculate the ratio. So that gives you a ratio of 2. So that ratio will be maintained for the next 3 years. If you go back to the information provided in the question, this ratio will be maintained until the end of 2021. So we can expect this ratio for 2019, 2020, and 2021. So the benefit that you have, guys, is you've already calculated the post-tax operating cash flows. So all you do is you take these post-tax operating cash flows for 2019, 2020, and 2021. You multiply that by 2, because we know that a constant ratio of 2 will be maintained until the end of 2021. So multiply that by 2 to get your balance. Now, what's extremely important when calculating free cash flows, we don't include the balance in our calculation. Instead, we include the movement in our calculation. We are interested in the movement in working capital and the movement in capital investments. Think about this logically, guys. Capital investments is property, plant, and equipment. So we are not interested in the balance in property, plant, and equipment at the beginning or end of the year. We are interested in the movement because we are trying to calculate cash flows. So if there's a movement, it means that the company acquired property, plant, and equipment or disposed of property, plant, and equipment during the period. So we are calculating cash flows, meaning we want the movement and not the balance. So obviously, before you can calculate the movement, you need the balance. So take these balances over here, and using those balances, calculate the annual movement. And you'll see in our calculation, when we are calculating free cash flows, we include the movement in our calculation and not the balance. Now, guys, you do need to know whether this movement is a cash inflow or a cash outflow. So in this question, you can see the balance is increasing each year. And with the balance increasing each year, I have a cash outflow. So for now, please note that is your rule. If the balance is increasing, there's a cash outflow. If the balance is decreasing, it's a cash inflow. I'm now going to discuss the logic behind that rule. So obviously guys, I don't ever just give you rules to learn. You always need to study the logic behind the rule. But in a test or exam situation, you won't always have time to go through the logic, okay? So just note, if that balance is increasing, you have a cash outflow. But let's cover the rule behind this so that you understand the logic behind what we're doing. Let's first look at capital investments. So remember guys, this is the company's property, plant, and equipment. Now, if the property, plant, and equipment balance is increasing each year, that means that the company must be buying property, plant, and equipment. And if they are buying property, plant, and equipment, that is going to be a cash outflow. Okay, so that is consistent. It's a cash outflow, and we can see over here, these are all cash outflows. That makes sense. Let's make sure that you also understand the logic behind the movement in working capital. Remember, net working capital is current assets less current liabilities. That gives you net working capital. So guys, the net working capital balance is increasing each year. So this balance is increasing each year. Now, if that balance is increasing, it means current assets are increasing or current liabilities are decreasing. Because if current assets increase, net working capital will increase. And if current liabilities decrease, net working capital will increase. And that's obviously because we are deducting current liabilities in this calculation. So if we deduct a smaller amount, that will cause net working capital to increase. All right, so guys, we can see that the net working capital balance each year is increasing. So we know it's increasing. What are the potential reasons why it's increasing? Either it's because your current assets are increasing or your current liabilities are decreasing. So what's sitting in your current assets? That's inventory and debtors. Now guys, if inventory and debtors are increasing, that means the company's buying more inventory, and it means that debtors are not settling their accounts. So both of these things indicate a cash outflow. So if current assets are increasing, that would be a cash outflow because it means inventory and debtors are increasing. On the other hand, if current liabilities are decreasing, that means the company is paying its creditors. And if the company is paying its creditors, that would be a cash outflow. So, there's my explanation behind the rule. The rule that I gave you was, if this balance is increasing, you have a cash outflow. Here's the logic behind the rule. If PPE increases, that is a cash outflow. So this is a cash outflow. If net working capital increases, that means current assets are increasing, meaning inventory and debtors are increasing, which is a cash outflow. Alternatively, it could also mean that current liabilities are decreasing. And if current liabilities are decreasing, the company's paying its creditors, and that is also a cash outflow. So everything tells us that this increasing balance each year is a cash outflow. So go back to your calculation. You can now take into account the movement in net working capital and capital investments. Make sure that you reference correctly to your calculation, and these are cash outflows. Guys, we have then completed this calculation. We've calculated our free cash flows. So we've estimated the future free cash flows. Now we need to calculate a continuing value. Now the reason why we need to calculate a continuing value is without this calculation, we are assuming that Springfield will only exist for the next 3 years because we are only looking at cash flows for the next 3 years. Now, obviously, if the company is a going concern, they shouldn't only exist for the next 3 years. The company should exist in perpetuity. So that's why we calculate a continuing value. We are performing a calculation, or a perpetuity calculation, because the company is a going concern and they will still exist after 2021. Now, please remember, when calculating the continuing value, we apply the principles of Gordon's dividend growth model. So, with Gordon's dividend growth model, we take the future expected dividend and we divide by the cost of equity less growth. Now, when we are dealing with a valuation where we are looking at free cash flows, the terminology just changes. Instead of working with dividends, we are working with free cash flows. And instead of using the cost of equity, we use the company's WACC. But we are following exactly the same logic as Gordon's dividend growth model. So what we do, guys, is we've already calculated our free cash flows for 2019, 2020, and 2021. We now need the cash flow for 2022. That would be the next financial year. So we take the cash flow for 2021 and we need to grow that to calculate the cash flow for the next year. Now, if you go back to the information provided in the question, you were told that free cash flows are expected to grow at a constant rate of 8% per annum after 2021. So after 2021, so in other words, in 2022, your free cash flows are going to grow at a constant rate of 8% per annum. Now, please note here, guys, because it's silent, you can assume that this is the nominal growth rates. And remember, if this is the nominal growth rate, it includes the effects of inflation. So inflation has already been taken into account. In any questions, it's safe for you to assume, if you are just given a growth rate, you can assume that that growth rate is a nominal rate and it takes inflation into account. The only time that you should still adjust for inflation is if you are specifically told that it is a real rate. Then you know it ignores inflation and you still need to take inflation into account. If it's silent, assume you've been provided with a nominal growth rate. All right, so we can easily calculate the free cash flow that we expect to have for 2022, because after 2021, free cash flows are going to grow at a constant rate of 8% per annum. So you just increase that by 8%. So that gives you the free cash flow in 2022. All right. We then divide by the WACC. So if you go back to step 1, we calculated the WACC to be 15.2%. So divide by the WACC and deduct growth in perpetuity. So if you have constant growth in perpetuity, you need to deduct that in your calculation over there. We do have constant growth in perpetuity. You are specifically told that the free cash flows are expected to grow at a constant rate of 8% per annum after 2021. So we've got consistent growth in perpetuity. All right, and then you calculate your present value. But remember, guys, this jumps back 1 year. So if you are including the free cash flows for 2022 in your calculation, this is going to jump back 1 year and give you a value in 2021. So you are using the cash flows for 2022, it jumps back 1 year and it gives you the value in 2021. So the value that you've calculated over there, you add to your cash flows for 2021. You can then total all of your cash flows. And please remember, guys, you must always show your calculator steps. So input all of those cash flows into your financial calculator. We use the company's WACC as our discount rate. So in step 1, we calculated the WACC to be 15.2%, and you calculate the net present value. All right, and that completes step 2.